This is Viewpoints by Hennessy, a podcast featuring the latest thinking from the team at Hennessy Funds. My name is Jay Coulter, and joining me for this episode is Dave Ellison, portfolio manager of the Hennessy Large Cap Financial Fund and the Hennessy Small Cap Financial Fund. Now, Dave has been recognized by Morningstar as one of the most tenured mutual fund portfolio managers in the financial services sector. We're going to discuss Fed moves, the health of the banking sector, inflation, mortgage rate fallout, and potential CRE fallout. Dave, this is your second appearance on Viewpoints by Hennessy. It's great to see you again.
Yep, good to be back.
All right, let's dive right in. What moves do you see the Fed making over the next 6 months?
Well, I think the Fed's made a lot of moves in the last year and a half or so, and I think they're getting near the end of what they're going to be doing, which is basically raising rates. I'm not trying to predict it or call it. The market pundits want to do that because they all think the Fed should be lowering rates. But I think we should be careful to think about the Fed moving in one direction or another without the data to follow, because they've been very data dependent. And I also think people, the people in the market, the people in the media, the people on Wall Street, they want rates to fall. And my concern is what would make the Fed reduce rates. So, if it's going to take a major recession to reduce rates, I don't think anybody wants that. And so I think generally I think we're in a good place right now. The Fed is data dependent. The market is handling the higher rates, and the companies are adapting to the higher rates. And I think we're in a much better place than we were when rates were at zero.
Yeah, and Dave, with the rapid increase in mortgage rates that we've seen, we haven't noticed any real structural destruction of housing prices yet. We would normally expect that in that type of aggressive rate-raising environment. What do you think's going on?
Well, I think you can make big sort of generic pronouncements. There's been underinvestment in housing for many years, primarily driven by the regulatory structure that came about after 2008. The other issue is the baby boomers are trying to move, but they're finding that, the house they want to buy in Florida is actually more expensive than the house they're trying to sell in New England. So it's keeping that at bay. I think obviously the rise in rates has hurt a little bit, although not as much as people would think. But I think generally you have a generational shortage of housing. It's keeping prices high. And I think that's going to be with us for a while. And it may be longer than a lot of people want it to be. But I think there's a real generational issue with housing in terms of the supply-demand imbalance that we have.
Yeah, it really is an interesting phenomenon. I live in the suburbs of Atlanta, and as rates have gone up, the houses were already inflated. I expected some downward pressure. Dave, we haven't seen any. In fact, we've seen some housing prices go up, and demand is still there.
So I think there's two generational issues happening here. One is housing, driven by what happened in 2008, which was basically no bank ever wanted to make a mortgage again, because if they did, they'd get sued by the government. You remember, Bank America, JP Morgan, Wells Fargo, Citi, they all paid billions and billions of dollars to settle claims that they had falsified and given people bad mortgages. And nobody wanted to finance housing. And now we're way, way behind. And the other issue is the generational issue of the baby boomers. They're retired, but they can't move. Mm-hmm. Because the house they want to buy in Florida on the water costs more than the house that they have in New England. So moving doesn't work for them. And so they're stuck. And I think the other big generational issue is labor. The baby boomers are retiring. There aren't enough people filling in, and we don't have enough immigration. And so you have a shortage of labor. So you're going to have a shortage of labor and a shortage of housing for a long time. And that's going to put pressure on a lot of things that we're not really sure, what that means. But I I think labor and housing are both in short supply, and I don't see how that changes anytime soon.
So, Dave, let's pivot. You have a wide lens into the financial services sector. As we sit here today, heading into the fourth quarter of 2023, which subsectors of the financial services industry do you feel are potentially undervalued today?
Well, I think the cheapest names, in the space are the ones that have the most credit risk. So it's the auto lenders, it's the high FICO or low FICO score lenders. Um, it's the credit cards, it's the auto lenders, and the most expensive names are the ones that don't have a lot of credit risk. And so I think it's very, the sector is broken down sort of in the last really 6 to 9 months along sort of where your credit profile is. And so it's hard to really say, well, I'm going to buy the real cheap stuff because I'm going to be okay with the credit risk. So I think we need a credit cycle to flush it out and see how bad or how good things are going to be. And then we can be more comfortable about what we're paying for these stocks. So this sector is very diverse. There isn't generally, a reason to buy them all at the same time, but a credit cycle does a lot of good things for the group. We just haven't had one in a long time. And so hopefully we're due for one.
Well, with that in mind, when you look at the regional banks today, do you feel like they could withstand a real recession?
Well, I guess a real is subject to definition. I think generally they understand the risk that credit brings. Not that they didn't know that going into 2008, but I think that they're better prepared, they're better capitalized. But the market's not really believing it. I think we've got a sort of a bifurcated market where you've got a lot of high multiple stocks that grow and innovate, and that's primarily tech. And then you have things like banks that really can't grow. They don't innovate. They're regulatory constrained and the PEs are low. And, but it doesn't mean they're not prepared for the environment. The market just isn't going to believe it until the environment shows up. You're not hurricane ready until after the hurricane. Then you know who was ready. And I think that's what we need in this group to kind of flush it out.
So commercial real estate's been getting a lot of press lately about the potential risks or perceived risks in that space. How are you looking at commercial real estate today and going forward for the next 12 months?
Well, I think that, everybody's certainly focused on commercial real estate, primarily, office in the major cities around the country, obviously related to what's happened around the world the last 3 years. The return to office has been slow. People have found other ways to work, and primarily from home. And so I think that's affecting the office market. And you are seeing situations now where banks are telling you they have non-performers where they're in these markets and the losses are pretty significant. So I think the data is out there. It's not, you can't, I'd call it one-off right now, but it may get a lot worse. So I think commercial real estate has been a good market for a long time. The values are high, rates are up. So, obviously the cost of carry is higher. So it's going to be a challenging market to obviously lend into the next couple of years. But again, I don't think the banks are overly exposed, though they will, talk about it and have to deal with it in the next couple of years.
Yeah. Let's wrap up with this. So you manage 2 funds at Hennessy Funds. How are you positioning them as you head into the fourth quarter of 2023?
Well, again, so at Hennessy, we have 2 financial funds, a large cap and a small cap. And a large cap sort of has the names that you expect to be in it. And what I'm trying to do there is basically give you the best large banks that are out there, that are prepared, that are diversified. The small cap is, it's mostly a bank fund in a sense that the smaller you get, the more sensitive you are to the spread and to the yield curve. And there, obviously, it's been a very difficult environment for them. But again, there's less credit exposure and there's more geography, sensitivity, which can help you in times of credit stress. So I think that, the funds I feel like are positioned well going into what could be a recession, what could not be a recession. The valuations are attractive. And we're kind of just waiting for the market to come back to this space. It's been out of this space for a number of years now. And so we'll just, we're trying to give the investors who want to own financials the best opportunity to make money when the group starts to come back in favor again.
Dave, thanks for coming back on Viewpoints by Hennessy. Viewers and listeners, to learn more about Hennessy Funds, visit hennessyfunds.com.
You're welcome. Good to be here again.